Ever stare at a stock chart and wonder whether you're watching Wall Street or the line for Space Mountain? Hang on tight, because by the end of this 5-minute ride, you'll know exactly what an uptrend, downtrend, bull or bear market, sideways move, consolidation zone, accumulation phase, and reversal pattern really mean for your money. So let's get started. First on list is an uptrend. Picture an uptrend as a stairway where each step is higher than the last. Prices keep making higher highs and higher lows, kind of like how your Starbucks order somehow costs more every year. Traders love following the trend because, well, the trend is your friend, until that friend forgets your birthday and bails. Flip the chart upside down and you have a downtrend. Lower lows and lower highs that looks suspiciously like your iPhone battery after one too many Netflix episodes. Short sellers treat downtrends the way bargain hunters treat Black Friday. Everything's on sale, while long-term investors feel the same dread you get when Monday rolls around too fast. Zoom out and you'll meet our two mascots, a bull market and a bear market. First, let's talk about bulls. It is a months or years-long uptrend across the whole market. Think 2010 through 2021, when seemingly every stock, ETF, and random crypto coin was moonbound. Bulls charged like a Walmart doorbuster crowd at 5 a.m., fueled by optimism, stimulus checks, and memes. On the flip side is bear market. It appears once the major indexes drop 20% or more from their highs. Investors panic, and 401ks feel the swipe. Kinda like Yogi stealing every picnic basket in Jellystone. Bears are scary, but they also serve up discounts worth nibbling through dollar cost averaging. But sometimes the market isn't charging or swiping. It's just pacing. That's a sideways market, also called consolidation. Price bounces between support and resistance, like your GPS stuck recalculating on an I-95 road trip. Volume drops, traders catch their breath, and everyone waits for fresh info. Earnings announcements, Fed meetings, or Taylor Swift dropping another surprise album because yes, even that can move the S&P nowadays. In all that fuss buried inside, or right after, a downtrend you might spot an accumulation phase. Big money quietly loads up shares without making a splash, the way NFL scouts lurk at a Division III game. You'll notice volume creeping higher, while price pretty much taking a nap. Think of it as Costco shopping. Carts fill up, nobody brags about it yet, but when the buying's done, the beach ball pops up and price lifts off. Then come reversal patterns. The market's plot twists. A double bottom forms a W for winning. A head and shoulders looks like Dwayne "The Rock" Johnson flanked by Kevin Hart and Danny DeVito. Big peak in the middle. Two shorter ones on the sides. Spotting a reversal feels like watching the final 2 minutes of a tied Super Bowl. Everyone's holding their breath, popcorn in hand, waiting to see who scores next. Let's hit a lightning recap. Uptrend, stairway to gains. Downtrend, gravity doing its thing. Bull market, a long, happy road trip with great gas mileage. Bear market, traffic jam with shrinking snack supply. Sideways, charts coffee break. Accumulation, carts quietly filling. Reversal, the U-turn you didn't see coming. Now, if these market trends are now much less terrifying than your tax return, smash that shiny subscribe button harder than Americans hit the snooze on Monday morning. Your portfolio and my fragile self-esteem will both thank you. I'm your stick figure host. This is Stick Finance 101. And remember, the trend is your friend until it ghosts you.